Welcome to this explainer. Okay, today we are doing something I am super excited about. We're taking what usually feels like a dense, overwhelming, and frankly confusing encyclopedia of trading strategies, and we're transforming it into a highly visual, incredibly organized toolkit. If you've ever looked at a trading chart and felt like you were trying to read an alien language, well, you are in the exact right place. We are going to decode it all, step by step, right here. So, how do traders predict the unpredictable? I mean, it feels like utter chaos, doesn't it? You've got prices bouncing up and down based on global news, algorithms, and just raw human emotion. But today, we're putting on our market detective hats. We're going to look right past that apparent chaos to see the invisible frameworks, the rules, and the mathematical principles that traders actually use to make sense of the madness. Here is our roadmap for today. First, we'll map out market structure. Then we'll visualize price action and decode chart patterns. After that, we'll dive into indicators and momentum tools, before finally wrapping up with some advanced and honestly pretty unconventional theories. Let's dive in. Section 1. Mapping market structure. All right, before we add complicated tools to a chart, we need a foundational map. Understanding market structure is the absolute baseline for reading any financial chart. It defines the behavior, condition, and flow of the entire market, and it's actually quite elegant. If the price is forming higher highs and higher lows, you're looking at an uptrend. If it's forming lower highs and lower lows, you're in a downtrend. It is the rhythmic pulse of the market, pure and simple, and it tells you exactly who is in control, the buyers or the sellers. But what happens when that pulse skips a beat? We really need to contrast two massive concepts here. A break of structure happens when the price pushes past a previous peak, meaning the current trend is robust and it's continuing on its path. But a change of character? Well, that's exactly what it sounds like. The price completely breaks the previous structure, like dropping below earlier lows during an uptrend. This is a huge signal that the market is likely reversing direction. Grasping this is quite literally the difference between safely riding a trend and spotting a massive U-turn before you get caught on the wrong side of it. And based on that structure, traders draw their battle lines. We have static support and resistance, basically horizontal floors where the price bounces and ceilings where it gets rejected. Then there's dynamic support using indicators like moving averages that flow right along with the price. We've got diagonal trend lines for overall direction and those incredibly powerful supply and demand zones, often called order blocks. These aren't just random lines. They represent concentrated zones of human greed and fear. They're the specific areas where massive, significant price moves originated in the past, which makes them prime targets for future entries. Section 2. Visualizing price action. Now, if we zoom in on the specific footprints left by price, how we actually view them matters immensely. We can contrast three very different visual tools here. Standard candlesticks, like your engulfing, hammer, or doji patterns, are amazing because they show you immediate momentum or rejection right at that exact moment. But if you find that a bit too chaotic, you might prefer Heikin Ashi candles. These smooth out the trend colors to give you a much clearer picture with way less noise. And then there's Renko, which builds block space purely on a specific price change, completely ignoring time altogether. Just remember, while Heikin Ashi and Renko are fantastic for filtering out that market noise, they act as indicators, so they don't always show the exact real-time market price. Oh, and speaking of those individual footprints, we absolutely have to talk about fair value gaps. When a sudden massive candle forms because of a huge imbalance of buying or selling, it leaves a literal gap behind. These are drawn between the wick of the previous candle and the wick of the next candle. So why does this matter? Because this gap acts like a massive magnet. The price will very often get pulled right back to revisit and fill this exact zone before it continues on its main trend. Section 3. Decoding chart patterns. Its candlesticks are the individual footprints. Chart patterns are the predictive shapes they create when you zoom out. There are two main types to watch for. On one side, we have breakout patterns. Shapes like wedges, triangles, and rectangles typically form after the market has had a tight consolidation period. It's kind of like it's catching its breath before suddenly exploding in one direction. On the flip side, we have reversal patterns. Think double tops and bottoms or head and shoulders. These shapes happen at the very end of a long trend, serving as a huge, flashing warning sign to traders that a countermove is about to happen. Now, things get incredibly strict when we look at Elliott wave theory. This theory suggests the market isn't just random, it actually moves in a highly predictable rhythm of human psychology, unfolding in a 5-wave move followed by an ABC reversal. But just look at the rigid rules required here. Wave 2 absolutely cannot exceed Wave 1, Wave 3 must be the longest among the impulse waves, Wave 4 has to remain above the peak of Wave 1. It's a super ambitious attempt to predict the exact mathematical rhythm of the market swings. And those specific waves frequently tie directly into Fibonacci retracements. This is exactly how traders find those hidden levels where the price might bounce. Here's the procedural process. Step 1, identify a clear swing low and swing high. Step 2, drag your Fibonacci tool across those points. And step 3, you wait. You wait for the price to pull back to key mathematical levels, ideally the 0.382 or 0.618 level, to find your optimal entry point. This famous mathematical sequence essentially acts as invisible horizontal support and resistance. Section 4, Indicators and Momentum Tools. All right, let's add the mathematical instruments. Think of these as our dashboard compass. These momentum tools are most effective when the market is clearly moving in one direction. You've got the MACD, where an upwards crossover is bullish and downwards is bearish. You've got moving averages, where simply being above or below the line dictates the trend. The parabolic SAR plots these clear dots below or above the price, and the super trend gives you an undeniable green or red signal. They are fantastic for clearly juxtaposing bullish versus bearish momentum. But what if the market isn't trending smoothly? What if it's just chopping sideways? That is exactly where oscillators like the RSI and stochastic become absolutely crucial. They are designed to find overbought or oversold reversals, but arguably one of the most powerful signals a trader can ever get is divergence. This happens when the price is, let's say, forming higher highs, but the indicator is forming lower highs. The mathematical indicator is flat out disagreeing with the price trend, warning you that the momentum is completely exhausted and a reversal is imminent. You cannot accurately measure momentum without looking at the fuel driving it, volume. Volume is the actual money. It is the absolute lifeblood behind a price movement. When you see longer volume bars, it means higher trading activity, which visually validates the true strength of a trend. Whether you are looking at raw price volume, the VWAP, or volume profiles acting as key horizontal levels, volume tells you if the big institutional players are actually supporting the action unfolding right in front of you. Section 5, Advanced and Unconventional Theories. First up here, look at the highly specific, almost obsessive procedure for applying Gann angles. This isn't just drawing a simple line. You must lock your price-to-bar ratio, mark a specific swing range, draw vertical lines, and measure a perfect 45-degree angle. Traders use this incredibly precise geometric tool to measure a trend's true strength, based purely on whether the price manages to stay within those steep or shallow geometric angles. It literally transitions standard analysis into pure geometry.
And when we look at harmonic patterns, we are taking geometry and Fibonacci to the absolute extreme. These advanced shapes with fantastic names, the butterfly, the bat, the crab, they aren't just random squiggles on a chart. They rely on incredibly strict X, A, B, C, D guidelines. For instance, in a bat pattern, the move from point X to point B must have a precise Fibonacci value between 0.382 and 0.5. These are strict geometric shapes relying on exact math ratios to predict massive, high-probability market reversals.
Okay, so we've covered rigid structures, precise mathematical formulas, and strict geometric ratios. But now, actually, scratch that. We are going to completely shift our focus away from strict algorithms to something a bit more celestial. Yep, it's time for a surprising pivot. Yes, we are talking about the moon phases theory. There are actual traders out there who actively analyze moon cycles to time the market. The underlying theory here is that celestial cycles are directly correlated with human emotions and behavior, which in turn drives market buying and selling. According to this theory, a new moon aligns with a bullish market, while a full moon means a bearish market. Today, a lot of traders who look at this use it neutrally as a highly unique confirmation tool to supplement their other, more traditional strategies. And that brings us to the end of our roadmap, leaving us with this final, provocative question. With absolutely endless strategies at your fingertips, from mapping the basic market structure and reading price action, all the way down to harmonic geometry and even celestial moon phases, which tools will build your ultimate trading system? Just remember, there is no single magical indicator. The secret lies in taking the specific tools from this explainer that resonate with you and synthesizing them to build a completely personalized approach. Thank you so much for joining me on this explainer. Keep learning, and I'll catch you next time.